And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today, and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to another School for Startups Radio Stock Market Update. My name is Jim Beach, and I'm joined, as always, by Dale Gillham of Wealth Within. He's also the author of Accelerate Your Wealth. It's your money, your choice. Dale, welcome back. How you doing today? Good to talk to you this week.
Yeah, I'm fantastic, Jim. It's starting to really warm up here in Australia, so it's really nice after getting out of our winter and you're going into yours. So it's a little bit different, but really good week.
Well, everyone in America appreciates your warmth as all of us are wet and freezing, and so just the entire country is mad at you for that right now. Market has gone crazy, Dale. Every week we say that it can't keep going, and it just keeps going.
I know it has been really, really interesting, and over the last sort of 2 years since January 2018, we do need to be careful about contextualizing things into a very short term rather than more medium to longer term. But in the last 2 years since January 2018, I think the market's risen, or the Dow's gone up 12 or 13%. But it's gone up over 6% since December last year. So the last sort of 9-10 months, it's gone up half of that return. And obviously, last week it blew through the all-time high, which is really, really nice to see. So it's sort of like cut the chains, or threw it, pulled in the boat anchor, and now it's on its way to keep going more bullish. So I'm quite confident right now that the Dow will continue to move up over the next few months. So it's all looking good.
All right, but we have all of these seasonal weird things that happen. We got out of October safely. Last week we talked about December and how we have a great last week of December. Are all of the stereotypical things still in play, do you think, with the market the way it is now?
Oh, look, absolutely. It really is. It's the market always does what it always will do, and that's really one of those things that people don't necessarily understand with the market, in terms of the market. We drive the market, not the other way around, or our mood as a collective drives the market. Now, if we're happy and we're really excited, then the market will be rising. If we're in doom and gloom and despondent, then it's going to be the opposite way. And there's an old study, and maybe I might do this one day, but where they look at fashion, they look at movies and music and compare that to market moves. It's quite an interesting study from that point of view. But we've seen the Dow in 2019, it's up over 20%. Since December last year. Sorry, I quoted 6%, but it's up 6% in the last few months. Sorry, but the S&P's gone up about 24. The Nasdaq's up about 28. So it's quite normal to see these sorts of things moving. As I said, we run the market, not the other way. And if we're not so scared of the market, we'll keep buying. Now, it is interesting when we're looking at the S&P 500. I did a bit of research on the weekend, and I think it was 229 of the stocks in the S&P 500 outperformed the S&P 500 actual return of that 24%. So nearly half of the market actually outperformed it. And it really is a really good sign when you're seeing that. Generally, the market will rise for 2/3 of the time and fall for 1/3 of the time. You'll get things like Red October announcements. You'll get Santa rallies. You'll get all sorts of different things happening. There's another old saying, sell in May and go away. So there's a whole lot of these wives' tales that we've talked about a few times. So to me, that's just the market doing what it's always going to do. And fund managers, or the big fund managers, are very cyclical in what they do. They will buy and sell at certain times. They'll readjust their portfolios at certain times of the year, and that causes blips on our market. But it is quite interesting. And the highest gain, I'll give you the highest gain for the year so far of any stock was Advanced Micro Devices and Lam Research, and they both rose over around about 108% for 2019. How would you wish to bought them on 1 January, mate? we would have been fine. But the worst performers, Macy's, and I'll talk about that in a little while anyway. And TripAdvisor, Macy's was down 43% and TripAdvisor down 42%. And I will be looking at the stock charts of those later on in this report.
Those are both interesting. One, of course, is retail, so we would expect them to have a bad year. But with a travel website, they shouldn't be doing that. And I think I was talking about this a couple of weeks ago with one of my friends, that both of us have quit using the travel websites and we go straight to the airline and straight to the hotel sites now, because it's just better. It's a better experience. So I'm not surprised that the travel websites are down. Everyone I know has ditched them. So there are better ways to shop than the travel sites.
Oh, no, I have to agree with you. I mean, like, my recent trip to the Philippines on business, I was on TripAdvisor going, where do I stay? What are the best hotels? Looking for reviews. And I just kept throwing my iPad across the room saying, what are you doing on this thing? It was just so confusing. They kept trying to sell me all these different hotel deals and I wasn't getting what I wanted. And I often will book directly with the hotel nowadays and just look around, see what hotels are in the area and go and ring the hotel directly. You get a better deal.
You do. You get a better deal. Yes.
And I go straight to the airlines. I mean, I do fly Qantas because I do like flying Qantas. So I just go straight to Qantas and they do everything for me. It's really, really nice. But I will, fly American Airlines, but I'll go direct to them when I'm in the US and buy directly from them. So I totally agree with you. So it doesn't surprise me either that they're a bit weak.
Me either. Let's change topics for just a couple minutes, Dale, and do a little bit of education. Dividends. I love a dividend. I love a company that's paying me $4 or $5 every year just for owning their stock. You would think that buying a high dividend yield company would be a great investment, but you say no. Tell us more.
Well, it's not necessarily the case. The thing is, everybody loves a good dividend, and really it comes from investors and traders. They want two things. Research has said to me, people want two things when they go into the stock market. One, they want to control what's going on or control the investments themselves. But the second thing is they want a guaranteed return. Now, you can't guarantee a return in the stock market. So what people tend to do then is going, well, if I can't guarantee what the stock price is going to do, I'll just get a good dividend yield because I know I'm going to get that paid every year. So it doesn't matter what the stock price does. I will get my 2, 3, 4, 5% dividend from that stock. And I think that's why there's this whole myths around about buying dividend yielding stocks. Now, the high dividend yield is quite often a sign of a stock that's falling away. And just to explain to people, when you have a dividend yield quoted in the newspaper or on the media, it's based on the current share price. So, for example, if you have a stock and it's $1 stock, and the dividend yield is 5%, then that's what you're getting because it's based on the amount of dollars and cents in dividend it's paying. Based on the current share price. But let's say in a year's time that stock is now $2 and it's still paying a 5% dividend yield based on the $2 share price. You bought it $1, but your actual dividend now is 10% because you bought it at $1. And so what you're looking at, but the opposite also happens as well. As the share's falling away, the dividend yield gets larger and larger and larger. So if it fell to 50 cents, that dividend yield would now be 10%. But you've seen a stock fall 50% in price to get you that 10% dividend yield. And that's what I'm saying is not smart. You need to balance it out between capital growth and dividend yield and look at stocks that are good, they're making money, they're profitable, they're rising in price, and if they also pay good dividend yield, get into them. But it is interesting. I did some research and I'll show you some of that on some charts at the end of this report. But I'm also going to I've got a big spreadsheet I'm going to show up on my live YouTube show tomorrow night. So if any of your listeners want to watch, go to my channel, Wealth Within TV, I'll be showing the full spreadsheet. But if you bought all top 10 dividend yielding stocks on 1 January this year, the top 10 dividend yielding stocks in the S&P 500, your return as of last Friday, the 15th of November, would be a negative 12%. Your portfolio would have lost $1,243 out of your $10,000 capital invested. And the biggest loss was 34.46% with Macy's that we've talked about. But the biggest gain was 10.89% with Iron Mountain. Now, as we talked about a little bit earlier, that's not a lot when you're seeing nearly half of the S&P 500 stocks did over 25%. So to me, that high dividend yield really is, or can be quite often, a sign of the stock price is actually falling. And so you just really do need to look at that and just don't go for dividend yield. Number one, always go for capital growth. No matter what you're doing, whether you're long-term buy and hold or whether you're a short-term trader, always go for capital growth first.
You know, Dale, maybe I'm too simple, but last week you convinced me that the way to do this is to own the top 10 stocks. Remember that the data was overwhelming. Hold the top 10 and readjust, resize your portfolio every year based on the top 10 of that year. I'm going to call that the Dale strategy and go with that. Are you going to be comfortable?
Absolutely, no problems at all. But that's the top 10 stocks by market capitalization. I actually did I actually did a research for my first book, How to Beat the Managed Funds by 20%, which was a bestseller in Australia. I haven't released that in the US, but what I did was I went to the stock exchange and said, give me the top stocks by market capitalization as far back as you can get. And they sent me this whole list on this fax paper that rolled up and, it fades, the old heat fax paper. And so I just marked down the top 10 and looked at them back 10 years and just said, okay, I numbered them 1 to 20. And then I said, okay, if I just had a portfolio of all the odd stocks, what would I get? And the even stocks, what would I get? And got the returns, and we're averaging 20% plus returns without any knowledge at all about the stocks. Then what I did is I took those two portfolios and numbered them 1 to 10 and did odds and evens again. So now I had 4 portfolios with 5 stocks, and we did just as well. So that was Dale's dumbed down technique. You don't need to be Einstein to figure out how to make money on the stock market. You just stay in the top stocks and just get a smattering of those, maybe 8 to 12 stocks, put that in your portfolio and go away. Come back 10 years later and you've made money. And it works on the stocks in the Dow and it works on the stocks in the S&P.
Well, it's a great method. I love it. We only have a minute or so left. Let's talk about the economy briefly, the macro situation. Not much really changed in the last week, did it?
No, remember we talked last month a little bit about consumer spending and everything and how it was down about 0.3% in September, but October it just made up what it lost. It was up 0.03% retail sales, but things are still slow. I mean, retail sales were up over 3% in October 2017, so you've got to compare that. So there's not much growth going on, and consumer spending is up 2.9% in the third quarter. Not massive figures. Unemployment increased, the employment rate increased by 0.1% in October to up to 3.6 from 3.5, the employment rate. So it really hasn't done very, very much. I mean, the US economy is probably flat. It's not necessarily bearish, but it's a bit flat, if that makes sense. But I think once the China trade deal gets done and a few other things settle, I think we'll get some better figures coming out over the coming 3 to 6 months, and I think that will drive the market. But that's also a signal to me that the Dow and the S&P aren't going to be as strongly bullish as what they were prior to 2 years ago, and that's where you get ebbs and flows in the market. And I've done some research where I look at the S&P 500 and the Dow against other world markets, and what you see is it's like a race. Sometimes one will speed up against another one and do really well for a year or two, and then the others will play catch up. And right now, the rest of the world's going to play catch up with the Dow. But I wanted to have a dig with you. Tesla's up 4.46% last week. So, and I know you don't like Tesla, but it's still going up, mate.
Yes. Well, I've been watching that one too. I know you want to make fun of me about that, so go ahead. I actually saw a commentator on the television, Dale, explain that consumer spending was down because of the impeachment. And I tried to put 2 and 2 together there, and I got 27 because I don't see any reason why I'm going to spend less because of the impeachment. I might spend more on liquor just to try to get through all of this silliness. So craziness.
I'm with you, matey.
What does the market look like this week, Dale? New highs? Are we going to hit 30,000 before the end of the year? Give us your final take.
I don't necessarily think you're going to hit 30,000 before the end of the year, but my target is 28,500 to 30,000 in the coming few months. So next 3 to 6 months, that's be fine. As I said, I don't expect spectacular rises in either the Dow or the S&P, but I think investors can be really self-assured that the market isn't going to crash. It's going to be trundling along nicely. I don't think much is going to happen before the election next year, and to me, it's, as I said to you, individuals make the market move, nothing else. Impeachment or anything else won't change what's going on the market as a whole, but I think everything looks pretty bullish. Get into the top stocks on the S&P and you'll do very, very well.
All right. Well, thanks a lot, Dale. We will hold you accountable. Again, Dale Gillham of wealthwithin.us. And the book is Accelerate Your Wealth. It's your money, your choice. Dale, thank you so much. And we will talk to you again next week.
Thanks, Jim.
And we will be right back.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, as I said in my report with Jim, I think the finally we've seen the Dow break out and starting to get into new territory. It did make a new all-time high last week, so that's exciting. But how far is it likely to go? How strong is it likely to be? And that's a real big question on many lips, given that the US economy is a little bit flat. So, but we'll have a look at the chart right now. So on your screen, I've got a monthly chart of the Dow Jones Industrial Average, and I just squashed it right up. And so this is data going back. If I actually scroll it back, you'll see even how far I've got data going back. So that here, right over there, that's 1900. So if I look there, you can see that's September 1900. So there's a lot of data that I've got on this market here. But and so a lot of my research is based on these hundreds of years of data. But if I roll back, what I've done is I've just used that's the 87 crash, or the low from 1987. Here's a previous all-time high that we had on the Dow in January 2000 before it ran down into that low into 2003. So that was really good. And you can see I've just extended that line out. And if you look where it is, this is why we're getting some resistance through here for it to break out. Now, stocks and or markets have a certain momentum. And what I mean by that in a certain momentum is they travel so many cents or so many points per day on average. It's like you, when you're driving on the highway or you're walking, you have a certain rhythm that you have. So you go to a certain speed. Markets do that. But like you, sometimes you'll go faster or slower depending on what's going on that day or how much you've had to eat. You might be walking a little bit slow and you might feel more energetic another day and go a bit harder. But right now what we're seeing is that the Dow has broken through that sort of resistance or that momentum that it has been running on. And so I think it's broken that elastic band, so to speak, or that boat anchor, and it's ready to start to rise. But how fast is it likely to rise? Now, looking at the Dow here, we can see here how on the current month, if I just drag that down, we can see it opened right on its close and it's closing on its high right through to the 15th of November. So we're halfway through the month. It is looking good. But looking at the market, we can see here, if I look at that, so that's from January there, or the January, and then we're almost, obviously we're only a month off the January, or next month, sorry, in a couple of months we're into January. But right now the market's moved 13% in roughly just under 2 years, so it hasn't done too much. And if we look at it in terms of since this month here, so we're looking at December, so that low end December, from the low end December, so this year it's 20.05% that it's moved, but 13% over a period, a longer, much longer period, another, well, as you can see, it's nearly 2 years over that period. That's why I don't look at buy and hold, or why I don't say people should buy and hold, because you're hanging on to things that aren't necessarily where you want to be. It's go into stocks when they're rising and stay out of them when they're falling. But you can see here the momentum, it's moving up through here, then sideways, and it does that quite a bit, some sideways, momentum moving up, sideways. That's pretty normal, sort of sideways-ish after momentum going up. So how long is this likely to be? Look, I suggest the market here is going to rise up for quite a few more months. It's probably going to get up into the realms of 30,000 points. It wouldn't surprise me if the Dow come down into the low towards sort of mid to end of next year at this point in time. But right now I think it's bullish. Yes, the economy is a little bit flat. But if the China trade deal goes through, a few other things happen, then we could see a nice spark in that market, and obviously the market will run. But it's slowing down. It's not going to run as fast as what it did through from 2015. That's what I'm sort of suggesting. That momentum is going to go a lot slower than it has in the past. I don't necessarily think there's going to be lots of great opportunities in the Dow, but it still will be trading up, and obviously the S&P 500 will trade up with all of that, as will the Nasdaq. Sorry if I can say that correctly. And the Nasdaq has been performing well. Actually, it was the best performing market in the US. The Nasdaq, I think, was over 30% for the year to date so far, where the Dow is about 20%. I think the S&P is about 23 roughly. So there might be more opportunities in the Nasdaq. But let's get into we've got a question for this week. So let's go and get into the question. Now the question I've got is from the PK. I'm not sure who that is, but that's great. If that's what your name is. Hi Dale, I love your videos. Thanks very much, matey. I'm not sure whether you're a guy or a girl, but thanks very much for your kind words. What do you think about ATVI on the Nasdaq? So again, what I'd like you to do, if you're going to post some questions, tell me a little bit about why you're asking me that question. Do you own it? Do you not own it? Tell me a little bit about it so that I can actually give it more context for you. Just what do you think about it doesn't mean anything to me. Doesn't mean about whether you're looking to buy it or you already own it, or whether there's something interesting about that stock that you want me to comment on. But let's have a look at it here, and I'll just make sure I've got downloaded the history on this. Looking at that, on the left-hand side of the screen, we have a monthly chart, and on the right-hand side of the screen, we've got a weekly chart. Looks really good right now. I think it's a nice-looking stock in terms of it is more bullish. We've had 1, 2, 3, 4, 5, 6, 7 months up to that high, 1 month down. Looking a tiny bit bearish this month, but nothing to be too worried about. I think if it gets through that sort of level, 57, 52. This one here is 57, 43. So right now, you know, it's had a low from that February there. It's moved up. It could be just going into more of a bit of a low at the moment, but that's a nice sign from last week. But right now, I wouldn't get into this stock at this point in time until it broke above those highs there. So they'll be sitting there. If I was owning this stock, it wouldn't be too far, wouldn't have to fall too far before I would exit at this point in time. So right now, as I said, just be careful a little bit, but it looks more bullish to me, looks more medium-term bullish to me, as I said. But that's all I can comment on, because I don't really know why you want me to look at it. Now, I'm going to bring up some of the stocks. Now, in my report with Jim, I did talk about top 10 dividend yielding stocks on the US market right now, and the returns for all of those. But some of the top 4 of those, or the biggest dividend yielding stocks, I just wanted to show you some of what I was talking about with Jim. Here's one that's called TripAdvisor, and most of people would be very familiar with TripAdvisor. And you can see it's been really, really bearish, and this stock has fallen quite heavily since that high back there, and down to this 54.87% since November last year. So again, if you were looking at this stock last year, 12 months ago, and you're saying, hey, it's paying a great dividend, I'd like to get into this stock, you've lost 54.87% of your money because you didn't look at the stock that well. So when you do look at stocks, and I really do know that a lot of people will look at a stock because it pays high dividend yields. And the thing is because people want to have that guaranteed return of the dividend. You need to get that out of your mind. Capital gain is and will always be far more important than getting a dividend, and I can't say that strong enough. It's nice hanging onto a stock to get a little bit of a dividend if you're losing a lot more when you're holding the stock. So right now, we're looking at TripAdvisor. It just looks terrible to me, and the dividend yield is going to get higher the more it falls away, because the dividend yield, the price of it in cents, dollars and cents, pretty much stays the same unless the company will actually reduces its dividend yield. But right now, this company does look sick. It doesn't look like it's going to travel up anytime soon, but hey, anything can happen. Let's go and have a look at another one. This one's called Macerich. I can hardly say that. Macerich if I can say that properly. Again, another stock looking really, really bearish, and all it's done is trade down on the history that I've got there. And you can see there it does it's probably finding a little bit of support across here on that weekly chart, but again, does look very, very bearish. And you can see here, if I put my little tool on it, that you'll notice, look at how far it's fallen. Look at all this data. It's been a really bearish stock since then. You can see down there, that's 70%. Let's look at it since here, from this point of view. From there, it's down around 60%. So it's a stock that has been really, really bearish. And you could have bought this back in the early 2000s and still not made any money. And this is, again, why I don't talk about buy and hold very much, because having stocks like this and holding them just to get a dividend will affect your portfolio greatly. That said, when it does run, it runs really, really hard. So you can actually pick this up here. And you can see it's run, more than 900% between 2009 and 2015. In 6 years, it's done very, very well. So when is it likely to do that? Don't know. But right now, it's finding a tiny little bit of support, but it's way too early to have a look at this stock. So when they do start to move up and give you signs of strength, it's better to err on the caution side, to actually wait for a while before getting into it to make sure you know it's moving up, rather than going, well, it's paying a good dividend, it looks like it might have found some support, so I'll get in now. I'd rather wait for this to go past that $34 mark there before I buy into it. And yes, some people will go, but you miss out on so much profit. No, I don't. All I miss out on is so much more risk. And there's 22, nearly 23%. I'm missing out on the risk to get profit, whereas if you jump early, you might be getting or catching a stock that's just having a bit of a rebound before it falls away again. But right now, you can see why the returns aren't very good when you just go for dividend. You really do need to look at the stocks themselves and look at whether the metrics behind them, whether their EPS and their dividend yields, plus their EPS, PE ratios, and look at the company and see what they're actually doing, not just buy them because they're cheap, and not just buy them because they're paying a dividend. Look at this stock. Look how far it's gone down. And again, another one, way back into the 1990s, you still wouldn't have made any money on this stock, but it made a beautiful move out of 2008. So L Brands, this one is, we're looking at here. That's one of the ones, and it's paying a really good dividend. Again, it fell away. This has fallen away over 90% since its all-time high. It's fallen away an 83.91% since, November 2015. And so people would have been buying this all the way down to collect the dividend or the increasing dividend, and what's happening is it's just really affecting their portfolio. People would have dollar cost averaged this stock as it's falling away, buying more as it's falling away. Again, not a smart strategy. Go and read my book, Accelerate Your Wealth. It's your money, your choice. Available on Amazon and bookstores around the US. Just get online and get it, or go to the bookstore and order it from the bookstore. But it'll tell you why you shouldn't be doing these sorts of things, because they're portfolio killers. The last one I wanted to look at is Macy's, obviously a very, very well-known US retailer, Macy's, and it's again, looking at this stock, it's just bearish. Now, it is finding some support over the last few months since down there in August, but it doesn't mean it's bullish. It just means it's stopped falling for the moment. And I really would like to see it show a little bit more strength before I would get too excited about it. But we're looking at the whole history of it. Look at that. Again, another stock that you could have bought it in the 90s and you're still at the same price, or you've collected its dividends. Now, that's not how you should be investing in trading. And again, it does move beautiful when it does move. It does move up quite nicely, because you can see this low here to here. Now, a lot of people would have bought in there and it's over 130%. But if those people are still holding it, that bought in here, they're all losing money right now. And they've bought this falling knife, so to speak. If you go back to that all-time high, you can see here that now currently it was down 80% on what it was, and it's currently down 77%. Again, I wouldn't buy it till it got right up into this sort of area, that $16, $17, $18, $19 mark, to prove it's going up. And I'd be sitting on that, making sure that my money is in a stock going up rather than going down. And it's pretty simple. There's only three ways a stock can go: up, down, or sideways. If you get rid of the downward ones and the sideways ones, you're going to be fantastic. If all you did was get rid of the downward ones that are falling away on you, your portfolio would perform a hell of a lot better. And if you limited the ones going sideways, you do even better again. But that just takes knowledge, and it takes a bit of strategy, and obviously some rules and some techniques around that. So, but as I said a little bit earlier, if you haven't bought my book, Accelerate Your Wealth, It's your money, your choice. Get online, get your copy from, as I said, Amazon or wherever you want to go, or go into Barnes and Nobles or the other bookstores across the US and get yourself a copy. So, but that's it from me for this week. So thanks for sending in your questions, and thanks for watching until the end of this video. It's great, and thank you for supporting the channel. Now, if you have any questions that you'd like me to answer, just stick them below there. Keep typing. I will get to them, so get those fingers on the keyboard and start typing, and I'm really, really happy. But as I said, just ask me why you're looking at a stock, or what interests you about the stock, whether you own it or you don't own it, or any other question. Please, happy to do that. But remember, I do these reports every week, so hit that subscribe button wherever that is, and hit it now, and click the bell on the right of it so that you know when we go live with our latest stock market reports. But that's it again for me. I'm Dale Gillham, the Chief Analyst here at Wealth Within for today. Goodbye, good luck, and good trading.